Imagine a store that sells a product you really want. The price is $100, but every few years, with no warning, the store marks it down to $60. And every time, most customers panic. They throw it back on the shelf and say this thing is broken. That is exactly how most people treat the stock market. They buy when stocks are expensive and run when they go on sale. And that behavior is the invisible fee almost no one is willing to pay. Morgan Housel, in The Psychology of Money, says market declines are not a penalty, they are an admission fee. To earn long-term returns, you must pay a price: uncertainty, fear, and the pain of watching your balance drop. Most people think the market's job is to make them money every year. It is not. The market's job is to test how badly you want the returns. The test comes as falling prices. Over the last century, the S&P 500 returned about 10% per year on average. But average means some years are up over 20% and many years are down. Sometimes it drops 30%, 40%, even 50%. Those drops are not a bug, they are the system. You cannot get the 10% average without living through the terrible years. Imagine a guaranteed 10% return with zero volatility. Everyone would buy it. The fact that it does not exist tells you something crucial. Volatility is the price of admission. You pay it to access the returns that build wealth over decades. When you panic sell during a crash, you are demanding the returns but refusing to pay the fee. And the market has a strict policy: no refunds. This feels wrong because of loss aversion. Losing $1 hurts about twice as much as gaining one feels good. So when your portfolio drops $10,000, it feels like punishment, not a fee. But it is the same as the store sale. The price is temporarily lower. If you liked it at $100, you should love it at $60. Yet most people hate it. The investors who build real wealth learn to pay the fee without complaining. They do not try to avoid the drops, because avoiding drops means missing the recoveries. Some of the best market days come right after the worst. Step out to avoid pain and you miss the gain. The fee is mandatory. Pay it willingly or get locked out of the returns. So how do you pay the fee without losing your mind? First, reframe a market drop. When you see red, say, "I am paying the admission fee today." That turns fear into a transaction you agreed to in advance. Second, automate your investments so you keep buying during drops without emotional decisions. Third, stop checking your balance daily. The fee looks terrifying up close but tiny from a distance. Zoom out to a 10-year chart and those scary drops become blips on a line that moves up and to the right. Morgan Housel sums it up: the price of getting rich slowly is looking like an idiot in the short term. Every time the market drops, you will feel foolish for staying invested. That feeling is the fee. Those who refuse to feel foolish, who sell, who wait for clarity, never stay in the game long enough to win. So the question is not whether you're smart enough to spot the next crash. It is whether you're willing to pay a fee that feels expensive in the moment but costs far less than missing the destination entirely. Are you willing to look like an idiot short-term so you can be wealthy long-term?